Neither was the pandemic of 2020 predictable, nor was the escalation of India-Pakistan tensions in 2025. So both were important and unpredictable when it came to navigating the stock market uncertainties. At the 1998 shareholder meeting for Berkshire Hathaway, Warren Buffett said, "We try to think about two things that are important and things that are predictable." At first glance, this comment can seem quite innocuous. However, it is essential to classify major events based on their importance and predictability to successfully leverage the opportunities and take advantage of the uncertainty and the noise in the financial markets. Of course, nothing is perfectly predictable, but there are some things that we can have a sufficient level of confidence in. For instance, a couple of quarters of poor demand or a cyclical downtrend could be built into the earnings projections. But a healthcare or a geopolitical emergency can never be predicted. Similarly, for long-term investors, a dent in earnings for a year or two need not result in change in exposure to the stock. However, a long-term trend in market dynamics, like the tariffs and trade wars, which could offer a decadal opportunity in exports, are important to factor in. We classify these events into three types: both important and predictable, which means the earnings cyclicality or degrowth due to poor demand, rise in interest rates and inflation, or risk in lending is factored in. Important and not predictable, for instance, prolonged geopolitical tensions, and then the not important and not predictable, which means corporate actions, mergers, or acquisitions. So, the focus of long-term investors need to be on the companies that have a healthy profit profile and reinvest the profits aggressively to grow. When it comes to financial entities, the risk of non-performing loans, or also called NPAs, is a certainty. NPAs can at times become the biggest bane of contention for financial entities and often for the economy as a whole, as the 2008 financial crisis showed us. So, the regulator, RBI, does its best to keep the NPA stress predictable. The RBI now recently released guidelines on the expected credit loss based provisioning framework for commercial banks. The framework replaced the current incurred loss model. In simple words, banks and NBFCs must now report their expected NPA levels and provide accordingly rather than reporting as and when the NPA is featured on their books. So, why this move? Well, Indian banks have quietly written off Rs 16 trillion worth of NPAs over the past decade. Aggregate gross NPAs at the 46 largest commercial banks in India are expected to rise to 2.5% over the next 2 years. This is from 2.3% at the end of fiscal March 2025. What's worse, the gross NPA of the same sample of 46 banks could go as high as 5.6% if one of the two adverse scenarios in the stress test conducted by RBI come true. Now, if you are not alarmed, you should know that every basis point rise in NPA level shaves off a significant share of net worth of the bank. So, to ensure that the financial entities remain solvent, it is necessary to ensure that they predict the NPA risks well. Now, the reason why RBI is skeptical about provisions being made by banks and NBFCs is because few of them have been transparent about unexpected rise in delinquencies. For instance, Bajaj Finance recently spoke about its loan offering for medical professionals that has shown the NPA red flag. The loans to doctors segment, which was once favoured for unsecured professional loans, is the key contention here. For the lender, there was perceived income stability in these loans. However, the segment has witnessed a sharp rise in delinquencies in recent quarters. Consequently, many lenders, including Bajaj Finance, have reclassified both doctors and hospitals under the cautious category, reflecting a broader reassessment of unsecured risk. If you think this is a one-off case of spurt in receivables, think again. The Indian banking sector has endured multiple severe crises stemming from concentrated sectoral risks. The most debilitating paralysis occurred post-2008 following an aggressive credit boom era that led to over-leveraging. Infrastructure and metals were the epicenter of the non-performing crisis, peaking between 2012 and 2017. Fueled by cheap credit, companies in the capital intensive sectors took on massive debt for ambitious capacity expansion. When global commodity prices crashed and the domestic demand slowed, many large scale steel and power projects failed catastrophically. The sheer volume of bad loans forced banks into years of provisioning, crippling their ability to lend new money. The telecom sector exacerbated this stress due to policy driven shake-up and hyper competition. Expensive spectrum auctions and the aftermath of the 2G scam left numerous telecom companies deeply burdened with debt. Fierce price wars, particularly post 2016, eroded profitability, pushing several established players towards bankruptcy. Banks heavily exposed to these debt laden companies saw billions in loans classified as high risk. Then came real estate. Real estate sector added a continuous layer of distress to the system. Project delays and regulatory hurdles caused severe cash flow mismatches on the bank's book. So, systemically, banks and NBFCs became highly risk averse, prioritizing recovery and balance sheet cleanup over fresh lending. This self preservation mechanism starved the economy of essential credit, slowing investment. In 2025, apart from the niche lending to certain segments, the health of the loans to medium and small enterprises or MSMEs is a significant concern in the banking sector. Risk on loans to small enterprises is largely due to liquidity crunch. While on the surface the economy appears to be growing, there is considerable liquidity stress in the MSMEs. Their working capital cycles have stretched, leading to delays in making EMI repayments. The new RBI loan provision policy is expected to spike loan rejection rates. Plus, several banks and NBFCs could start reporting NPA provision costs significantly higher than historical averages. Now, amongst this, entities like Bajaj Finance, HDFC Bank and Kotak Bank have moved away from quick loan documentation approvals and started demanding more granular data. The entities are also tapping the applicant's total credit exposure across the entire financial sector. By integrating advanced credit bureau data and external sources, they are tracking the full quantum of unsecured debt that the borrower holds. So, even as the NPA stress becomes an important and predictable strain on the banking and NBFC stocks, with RBI's new provisioning norms, certain entities, like I mentioned before, deserve remaining on your watch list. Hope you like this video. Thanks for watching.